The ongoing uncertainty around U.S. tariffs on foreign goods is affecting business leaders across all industries. On April 17th, BMO hosted a discussion to cover macroeconomic trends that are specifically impacting manufacturers with our economic and industry experts.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/marketsplus for more episodes. The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries.
Hello, everyone. Welcome to our digital event, How Trade Volatility is Affecting Manufacturing. I'm Camilla Sutton, MD and Head of Equity Research for Canada and the UK. I'm thrilled you could join us this morning. Today, we stand essentially 3 months into the US's new administration as President Trump hits a 90-day milestone this weekend. And at this point, the US, and for that matter, most of the world, the trade policy has pivoted sharply and repeatedly. The US has imposed 25% tariffs on steel and aluminum, 10% on Canadian energy and potash, plus escalating levies on Chinese imports. While the rest of the world has also responded in various ways, including tariffs. These shifts are reverberating right across the manufacturing and global supply chain networks. And to help us really try to cut through the complexities of all of this, we have invited 3 of our experts to shed light on what is happening and how it even might evolve from here. We only have 30 minutes, so I'd like to start off quickly here by introducing the guests. We have Fadi Chamoun, who's a transportation analyst and managing director with BMO Capital Markets, and he's based in Toronto. We have Eric Johnson, the senior economist and vice president with BMO Economics, also based in Toronto. And we have Andrew Pappas, managing director, head of ABL Metals Group, BMO Commercial Bank US, and he's based in Chicago. And with that, let's get right to the meat of today's event. Eric, let's start with you. Can you really set the stage for us and walk us through where we are with both the Canadian and the US economy?
Yeah, thanks, Camilla. And, not to put too fine a point on it, but an environment where one individual can wake up, snap their fingers, and completely change the state of play for the global economy, the range of possible outcomes is pretty wide here. But with that caveat, here's how we're interpreting the current dynamics for both the Canadian and the US economy. So it's good to remember that tariffs here are a tax on consumers and producers. They tend to dampen growth and raise prices. And so even with the 90-day pause on some of the tariffs that were initially proposed by the US on April 2nd, the current trade policy backdrop is one that's not conducive to sturdy growth. It's worth bearing in mind the average U.S. tariff rate remains around 25%, or roughly on par with where it was in the early 20th century. So as Camilla was mentioning, that includes things like 10% tariffs on most countries, 145% tariffs on China, as well as 25% tariffs on non-USMCA compliant imports from Canada and Mexico, with a little carve out there for energy and potash from Canada, which face a slimmer 10%. As well, you have to remember there's still those sectoral tariffs that Camilla was mentioning on steel and aluminum and motor vehicles, and there's more to come with lumber, copper, semiconductors, and pharmaceuticals. And so keeping track of it all has become somewhat of a full-time job, and I think that speaks to the added burden of running a manufacturing business, or really any business these days. And so it's worth mentioning the U.S. is certainly less reliant on trade than many advanced economies, but we still see kind of that current trade policy regime creating a fairly stagflationary shock, with U.S. growth slowing to 0.6% on a Q4 over Q4 basis. And that's coming off a very strong year last year. And at the same time, we see core CPI accelerating to over 4% later this year. So again, raising some inflation woes that the Fed is likely to be concerned about. Canada, on the other hand, certainly managed to avoid any additional trade disruption from the latest round of U.S. tariffs. But, to paraphrase Prime Minister Carney, that still leaves it with the best of a bad deal. So Canada is much more reliant on trade as a small open economy. About 20% of its GDP is tied to good exports to the United States. And so we really see that mix of tariffs on steel, aluminum, auto, and, the fentanyl tariffs to, likely to tip the economy into a 2-quarter contraction in the middle of this year, with GDP growth averaging just 0.7% this year. And so faced with that weakening, dilemma of economic activity and rising inflation, we think that both the Bank of Canada and the Federal Reserve are ultimately going to lean into growth concerns here. So accordingly, we have the Bank of Canada cutting 3 more times this year, with the next time being in June. And that's ultimately going to bring the terminal rate down to 2%. And again, there's a little bit of further risk there if we get more kind of hiccups here with tariff policy in the weeks and months ahead. So for the Fed, we also having them cutting 3 times this year, and in our view, they're going to start coming off the sidelines here starting in the summer. So I think the challenge is, the risks are that, the longer we're under the current global trade policy regime, the worse the economic outcomes are likely to become. We're starting to see a preview of where the harder economic data could be headed from sentiment surveys. The University of Michigan Consumer Sentiment Index hit its lowest level in April, going back to 1952 for the US, and that's excluding 1 month in the pandemic. And similarly, Canadian consumer confidence plumbed to all-time lows in March. And one thing to bear in mind here is the resilience of the US consumer has been a key part of US growth exceptionalism over the past few years, and tariffs are very much putting that at risk. So that's roughly where we're seeing things kind of stand here, Camilla.
Eric, that's a great summary. You packed a lot into that. Can you drill down a little bit into the manufacturing economy? What do you expect to see, and what are you seeing in terms of the actual manufacturing economies in both countries?
Yeah, so I think zooming in on manufacturing, my biggest concerns are that it's really ground zero in a trade war. So a lot of manufacturing firms, if they weren't already aware, are finding out how interconnected the global economy is as they're being hit with tariffs from a whole range of inputs to their production processes right now. And I think, the desire to make trade fair and to create high-paying jobs in the US is a really admirable one. But I think the evidence so far, and from, previous episodes of tariff spikes, is that this current policy mix is unlikely to lead to a renaissance of U.S. manufacturing employee. I think what we're instead likely to see is increased production costs for manufacturing, and in some cases, they might even be disadvantaged relative to their competitors from abroad. For instance, if you're a U.S. manufacturer in high value-added electronics right now, chances are you're having to pay some form of tariff on many of your inputs, but your competitors in China and other countries, because of some of those exemptions, might not actually have to pay tariffs if they're just shipping a final good to the United States. And so again, something that's going to weigh a little bit more on domestic manufacturing than I think the goal of the stated policies is. And I think we're seeing some indications already of where this could be headed for US manufacturing, and certainly for Canadian manufacturing as well, based on the latest Empire State Manufacturing Survey from April. Again, it's just one region of the United States, but when you looked at some of those forward-looking expectations in that survey, they were really weakening considerably. New orders and shipments are basically expected to sink over the next 6 months, while prices paid and prices received are expected to rise. So showing a little bit of that stagflationary mix there. And again, that's not a great mix for future growth in US manufacturing. So again, I think setting up a manufacturing facility is both costly and time consuming. And the challenge is there isn't a lot of credibility that the current tariff regime is likely to persist for long enough to create the incentives to reshore activity. And so I think ideally you want to be crafting policy that's, set up in a way to encourage businesses to make long-term productivity enhancing investments. And one of the reasons why many advanced economies actually largely shifted away from raising revenue using tariffs, decades and decades ago, is that it creates incentives for firms to divert resources from business investment towards lobbying. I think the unfortunate thing we're seeing right now is that the returns to lobbying are extremely high if it means getting your key products exempt from US tariffs. And so I think one thing to bear in mind here as well, given the very integrated North American supply chains, I'm particularly concerned about the auto industry and other heavy users of base metals in the current environment.
Andrew, let's pivot over to you. Eric's done a great job of giving us the economic foundation. You're really focused in on the metal sector. Can you give us a sense from your perspective in terms of manufacturers rely very heavily on steel and aluminum? What do you see?
Sure, thank you. So steel and aluminum prices really started rising with the U.S. A lot of the steel producers, service centers actually have been pushing for tariffs, not necessarily on all countries, but they have been pushing for tariffs. And so the manufacturers and buyers of metal, they started after the U.S. election, they started buying more metal here when you're going through December and January, really in anticipation. And everybody had been through implementation of 232 back in 2018, which I will say it did bring back more production into the U.S. than ever before. A lot of new production that had not occurred. But for a lot of manufacturers, they've been through this before. They started buying early. They started hedging more. A lot of them are tied on contracts. It really depends manufacturer by manufacturer. But, the biggest concern, though, by the time the tariffs got announced, steel and aluminum prices had actually already gotten to that 25% and above that. Metal prices are always tied to indexes. Mills initiate the price increases, and then the supply and demand keeps it at certain levels. So manufacturers, they've had to, revisit kind of how they operate. And the problem is there are all these other tariffs that have been introduced, right? Now, we're not just talking about steel and aluminum. Eric mentioned, auto and reciprocal tariffs. And so it's a different situation today than back in 2018. Manufacturers all of a sudden have to step back and think, well, wait a minute, which ones of these tariffs are permanent tariffs, right? And what should I do today? And I think a lot of manufacturers, they're revisiting their cost structures. They're visiting their production schedules. Where are they getting? Steel and aluminum might have higher tariffs, but what about other raw materials that are going into their manufacturing process? Can they make more of their goods or buy more of the components to make their product domestically? At the same time, they're trying to understand, how the parts that they're manufacturing. Is it a critical component? If you're an auto supplier that, you're making various components, well, how are you sole source to your customers? What kind of leverage do you have with your customer to be able to pass prices along? And look, everyone's trying to pass prices along to the extent that they can. It's just not that easy for manufacturers at this point to figure out what are their actual costs, because I don't think they know the rules of the road yet. But there is a lot of adjusting. One thing I always realize is companies always adjust quickly, whether it's their production, their cost cycle, they're going to adjust. And buyers of components are also going to adjust, right? I mean, it's difficult to switch vendors just overnight. There's a whole approval process. So the various tariffs that have been discussed, announced, in addition to steel and aluminum, is going to cause a lot of negotiation, I would say, in the chain. And some price increases will be passed along, and others, will not be, because everyone is in a competitive environment. And, that's the other thing. There's going to be winners and losers on some of these manufacturers. And that's why everyone's kind of revisiting where they stand. And, the ultimate concern is there going to be demand destruction or substitution on some of their products? And that's where the concern of the manufacturers are. It's just not just the steel and aluminum tariffs, which brings some level of concern, but then where does this end is the biggest question.
So, Andrew, help us think through the pricing in particular, in a sense. I mean, you deal with all of these clients day in and day out. How are they planning to respond to these tariffs? And really, when it gets into the pricing, how do they think that through?
Yeah, I mean, if your steel mill increases came as fast as possible, right? From the steel industry, they view that there is not free and fair trade in the world, not necessarily from North America, but beyond North America. And so they've been pushing for tariffs until prices have quickly gone into market indexes, CRU on steel, LME and COMEX on for aluminum and other metals. So there it's been immediate. And obviously, prices are beginning to drop a little bit in the futures market. I think a little bit because of concern of where is this all going, right? Does that ultimately hurt demand? From the manufacturer's standpoint, again, I think it's kind of digging in, understanding, and look, it's going to make, I think, if these tariffs go away, then if anything, it's going to make manufacturers a little bit more understanding of their cost structure. They're going to have to dig in and understand, where can they become more efficient? Because it's clear that everyone's not going to be able to pass through all these tariffs to the fullest extent, because there's things called competition, and ultimate consumers are going to really decide, how much they're going to purchase or not. So every manufacturer is going to have to step back and kind of understand their cost structure, figure out, how critical is their component, can they make adjustments in their production process, and then negotiate whatever price increases they can. And it's a negotiation. There's nothing that's going to be simple, and leverage is important. If you got a product and you got to negotiate selling to, for example, an auto company selling a component to GM, well, there's definitely some leverage that the auto companies have, and they're going to push back on some of that. Same thing when it goes to GM selling a car in the consumer market. Well, how much is somebody going to pay for? How much higher will they pay for a certain car? And I think all those factors will play in eventually to where the cost outlook. But right now it's a challenging time for manufacturers. They're trying to figure out, again, it's kind of what's permanent, what's not, and the concern of where this all goes is real at this point, and it's bigger and broader than just the steel and aluminum tariffs.
Terrific, Andrew. Thank you for that. Fadi, let's pull you into this. We've had a great economic landscape summary from Eric and a really good U.S. commercial perspective from Andrew. From your perspective, you talk with CEOs across the transportation sector in both Canada and the U.S. every day. What trends are you seeing and hearing from them?
Yeah, thanks, Camilla, and thanks for having me on. So like you said, my perspective will be from kind of the issues we're seeing on the supply chain side. So we talked to dozens of companies in trucking, railroads, air freight, ocean freight, and we get decent dialogue. And I think we've probably kind of elevated the amount of interaction in the last few weeks just to kind of keep tab on the changes that are occurring. There are a lot of things people are trying to assess in this changing landscape, and really I find access to some people is easier than we have had probably in the last few months, because I think everybody's trying to learn from each other. Everybody's trying to figure things out. But I'll share with you some of the things that we are seeing right now. First, we are seeing transportation companies really pull back on their investments in capital. I think in multiple cases, we have seen this occur in the last few months, and I think concerns are over potential weakness in demand, but also not really having good visibility into where the capital investment need to occur, because really there's a lot of uncertainty or where this kind of all is going to end up from a supply chain perspective. I would also say that some companies are trying to preserve financial flexibility, protect their balance sheet. So you can say that if this kind of behavior persists, it will be felt across the economy to some degree. A second maybe takeaway is companies we talked to in the past couple of weeks is trying to emphasize controlling what they can control. So often that means tightening their focus on costs, on expenses, down to essentials. Some have enforced even stricter travel policies. Another indicator that I think is important to to put in context of what this potentially could mean for the economy if this type of behavior persists is these companies potentially tightening on capex, tightening on opex, that's potentially have some negative implication. Now, on the more operational side of things and production side of things, it is really early days, but some of the shippers we talk to, some of the companies we talk to, are already taking steps to shift production when they can to avoid tariff, defend their market position. I'll give you a few examples that we've already seen in the supply chain right now. GM makes trucks, light trucks, both in US, in Canada, and they make some of them in Mexico as well. I think GM have announced that they ultimately are looking into adding a third shift to their US plant, hiring more people, and potentially reducing some of the production for these trucks in Canada and Mexico. So you can argue, like, if you look at, Mexico makes 4 million vehicles, 900,000 of those 4 million vehicles are models that are also made in the US. So to the extent that capacity is available and labor is available, so it's not an easy process, takes time, but this is not something that will require a significant amount of kind of new plants and equipment. You can argue some of these moves are starting to occur, and we'll probably start to feel, the impact of those in the next 3 or 6 months. On the Canadian side, of the 1.2 million vehicles made in Canada, about 400,000 are models of cars that are also made in the US. So we're starting to see some of these things kind of move around, shift around. But, like I said, it's very early days, and I think to a large degree, people are still wait and see mode. The other thing that strikes me as interesting is some of the companies we talk to in Canada are starting to intensify their communications with the transportation company, like railroad and trucking, and availability of assets and equipment. And it really, it feels like setting up potentially the future supply chain. So government agencies, the Ministry of Transport, have contacted railroads in Canada and asked them, if they were to be a shift towards, greater export of resources, what kind of bottlenecks do they anticipate potentially in terms of exporting resources through ports? So there's a lot of work being done, I think, in anticipation and preparation for potentially long lasting, maybe a trade conflict here, and potentially a shift in some of the sales focus maybe on exporting out of the Canadian West Coast or East Coast instead of what we're seeing today from a supply chain perspective. So I thought that was interesting. We haven't really seen that in the past, and government are trying to step in and basically see if there are bottlenecks to debottleneck them a little bit ahead of time. On the demand trends, I think there's really clear signs that some freight demand that has been pulled forward in probably the last 2-3 months. Shippers are taking more wait and see approach. This is resulting in very unpredictable, really, outlook for the second half of this year. So far, there are reports that shipping lines have canceled almost 90 sailings from Asia to the US, mainly from China. This is meaningful. We're talking about ships that carry, 8,000 to 13,000 containers. So you can do the math, 90 ships times, 10,000 containers per ship. You could be, closing in on a quantity of near 1 million container potentially being pushed off. So the math here leads you to conclude that substantial impact on volume will happen in the next couple of months. There's maybe 30, 45 days lead between when these ships turn around down the time basically between Asia and the US. So now these are have potentially significant repercussion to the inland transportation side. How many trucks are not going to be needed to evacuate containers that typically come at the port? The same thing on the railroad side. Consider that this is occurring already while the transportation industry is still reeling from almost 3 years of freight recession. So many trucking carriers are barely hanging on. That's probably good news and bad news, because I think ultimately, if we see a step down in demand, we're going to see a step down in supply, because the industry is barely at break-even point from a profitability perspective. And I don't think a lot of companies, especially in the trucking side, can really afford to operate with significantly lower demand. So, look, transportation in most ways also have asset mobility. So I think the strong operator are, going to be able at the end of the day to mobilize their assets and their resources to meet the future supply chain, whatever that's going to look like. And I think some of the trade shifts, if we're moving kind of trade away from China to some degree, that's going to cause some, import changing from, the West Coast to the East Coast. That's typically the case because, anywhere that, manufacturing shifts, say, to Southeast Asia, it's going to be much quicker to go through the East Coast than to go to the West Coast. So these trade shifts had already been in play for a number of years. Those could accelerate and, ultimately will determine different set of winners and losers in the transportation side of things. And I think for shippers, also how they think and manage their supply chain is going to require some re-engineering of those supply chains as well. So those are the things they're saying. I'll stop there. Camilla, if you have any questions.
Thank you for that, Fadi. It's tremendous to always see the depth of expertise you have here. We're coming up very quickly to the end of our half hour, but before we leave, I did want to stop in with each of you and just hear very quickly, what would you really like our audience to leave with today? And Eric, why don't we start with you, and then we'll move to Andrew, and we'll close out with Fadi.
Yeah, thanks so much, Camilla. So if there's one thing that I could leave people with, it's that the current economic situation we find ourselves in, really reinforces something that our CEO, Daryl White, said earlier this year. And that's that capital craves certainty. The challenge for the global economy is that the current fashion in which trade policy is being reshaped creates tremendous confusion about what the rules of the game are going to be going forward. And so in that kind of environment, sometimes the optimal individual response for companies can be to hoard and hold. And while that might make sense for the individual, often in the aggregate, it leads to a weaker backdrop for future growth. And so that's, I think, the thing I'm really focusing in on as we go forward here.
Andrew?
Yes, I would say one major thing, which is, a tariff is a tool for onshoring, and if it used effectively, it sometimes can work. Any tariff is going to result in higher prices ultimately throughout the entire chain, and too many tariffs is going to end up in demand destruction, substitution. So it's a very sensitive topic, and it has to be applied reasonably. Thank you.
Fadi, last words from you.
Yeah, look, I think from a perspective of a shipper, manufacturer, I would say, communicate. I think what I'm finding is really people are hungry for, talking to other people in that supply chain and this environment and kind of learning from each other, because it's very unprecedented and there's a lot of discovery still to be made, I think, in terms of how all these things will shake down at the end of the day. So communication, I think, is important, but, managing your carriers, ultimately ensuring that your provider of transportation have the balance sheet and the capacity to put at your disposal. And I think in an environment like this one of a lot of kind of chaos and uncertainty, brokerage, freight brokerage, whether it's air, ocean, or surface transportation, are a very good tool to help you find capacity and ultimately help you kind of navigate this and match your needs with capacity. And I think if you're an investor, there's a lot of opportunity if you're willing to look over the valley. I feel that stocks have kind of pulled back quite a bit, but I would again focus on quality networks with quality management and quality balance sheets, and potentially companies that have some self-help improvement opportunity that I think you could look at them from an investment perspective. And I think, like I said earlier, we're in the third year in this freight recession. I think if demand steps down, supply is going to step down. So I'm not really expecting that the cycle will worsen. I think the downturn is potentially prolonged, but I don't suspect that there's a lot of room for downside in terms of kind of margins and profitability here for these companies. So that's a couple of takeaway from me.
Eric, Andrew, Fadi, appreciate you all joining us very much today. Thank you for that. And as always, BMO, we're committed to helping our clients, even in the most complex of environments, with our extensive cross-border resources, expertise, content. Your BMO relationship manager is more than happy to help direct you if you're unsure of where to go. You can also visit our websites, capitalmarkets.bmo.com or commercial.bmo.com. You'll be able to see the video replay of this podcast and a recap article of today's event, along with updated content on tariffs and trade continually. Also, stay tuned for future webinar and digital events covering everything that has to do with macro and the current environment in which we live. And we also have an upcoming one on the Canadian post-election call. We were really glad you were able to join us today. We hope today's event was helpful. Thank you.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.